Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
You know, looking at the news this week, it feels like we're suffering from a serious case of cognitive dissonance.
It's been a very strange week.
On one hand, you have the absolute surrealism coming out of Davos. Donald Trump demanding to buy Greenland, Mark Carney declaring the old world order dead.
It has been an incredibly heavy week for geopolitics, probably the most significant Davos in a decade.
And yet right here in the city, while all that was going on, the Prudential Regulation Authority, the PRA, was quietly dropping 4 massive policy statements.
That's right, almost under the radar. And these are the documents that will define UK banking all the way through 2027.
It's such a strange collision of worlds. You have this massive global instability, but on the compliance desks, you have these very, very granular deadlines landing.
Exactly. And if you're in a retail banking team listening to this, you are sandwiched right between the two. You have to navigate the macro chaos while ensuring you actually hit these new targets.
We have a lot to get through. We're going to talk about that roadmap for Basel 3.1. We finally have a date, everyone.
Finally.
We're going to look at some honestly mind-boggling cyber failures involving spreadsheets.
Oh, that report was a difficult read for anyone in IT security.
And we've got a scandal on credit nudges, which lands right in the middle of the consumer duty conversation. And just to keep you on your toes, the most bizarre story of the year, a formal proposal for the Bank of England to stress test for alien disclosure.
And before you laugh, there's actually a very serious prudential logic behind that one. It's all about liquidity shocks.
I'll take your word for it for now. But let's start with the bread and butter, prudential clarity. The Bank of England published final rules, PS 126, on Basel 3.1. We have a date to circle.
We do. The headline date is confirmed as the 1st of January 2027.
Right, so a bit of a delay from the original timeline then?
It is a delay, and frankly, the industry will breathe a sigh of relief. It gives firms that crucial extra year to get their data pipelines in order. But there is a nuance here people need to catch.
Okay.
While the main regime credit risk, operational risk, the output floor, all that starts in January 2027, the market risk internal model approach, FRTB-IMA, that's been pushed back even further.
Oh, really?
To the 1st of January 2028.
Right, so a staggered start. That's helpful.
It is, and it reflects the sheer complexity of those trading book models. But at the same time, we also got the final rules on the strong and simple framework.
This is the simplified regime for the smaller banks, right? The SDDTs.
Exactly. To start building societies and challenger banks drowning in rules meant for the global giants. That also kicks in on January 1st, 2027.
So it's all aligned?
Well, not quite. And this is the check your inbox now moment. While the capital rules wait, the new rules on the frequency of your ICAP and ILEP updates, they're live.
Just to be clear, those are the internal capital and liquidity adequacy documents.
Correct. And specifically, the rules on reverse stress testing for these smaller firms actually came into effect this week, January 20th.
Oh, wow. So no waiting until next year for them.
Not at all. The clock is already ticking on the documentation. And, you know, my hot take on this?
Go on.
It's great to have certainty, but locking in 2027 feels incredibly optimistic given the geopolitical chaos we're about to discuss. We are codifying a framework based on international cooperation at the exact moment the cooperation is visibly fracturing.
Which is the perfect segue to Davos, because fracturing is putting it mildly.
Hence is the word. You had this incredible contrast, the technocrats trying to talk about AI safety, and then the geopolitical sledgehammer of Donald Trump's speech.
Let's get into that. He took the stage and essentially issued an ultimatum over Greenland. He called for immediate negotiations to acquire it for national security.
And he didn't stop there. He explicitly threatened tariffs on European allies if they refuse. It's just a purely transactional view of the world.
And what was fascinating was the business response. Howard Lutnick, Trump's Commerce Secretary nominee, stood up in Davos and declared that globalization has failed the West.
At Davos, the temple of global trade. It was a direct attack. He's basically saying, we are taking our ball and going home, unless you play by our rules.
And then you had Mark Carney, the former Bank of England governor, and didn't mince his words either.
No, he did not. He delivered what many are calling the most important speech of the week. He said, and I'm quoting here, the old order is not coming back. He called this a rupture, not a transition.
A rupture, that's a strong word. It sounds permanent.
It implies a break that can't be fixed. Carney's argument is that middle powers like the UK, Canada, can no longer rely on the U.S. or the old rules-based order. They need to band together.
And Larry Fink from BlackRock chimed in, too, saying that Davos itself is becoming an echo chamber.
Exactly. But here's why this matters to a compliance officer in Leeds or London. If regulation becomes a competitive weapon, which is what Lutnick is implying, there's going to be immense pressure on the PRA. If the U.S. deregulates to boost growth, can London really afford to stick to these strict Basel 3.1 rules we just talked about?
That's the tension, isn't it? We're locking in rules for 2027 just as the global rulebook is being torn up.
Precisely. If Wall Street gets the shackles taken off, London faces a race to the bottom, or it loses business.
Okay, let's bring it back from geopolitics down to the IT department. The 2025 CBEST thematic review from the regulators was released, and the findings were embarrassing.
Embarrassing is fair. The report found that despite all the money spent on sophisticated threat intelligence, firms are failing at what they call basic hygiene.
Give us the gory details.
The report explicitly mentioned that systemically important firms are still storing passwords in plaintext spreadsheets.
No! You're kidding.
I am not. And using open file shares for credentials.
That is just mind-boggling. We're talking about institutions that move billions of pounds, and they're keeping the keys to the kingdom in an Excel file called passwords.
It seems so. And the regulators were very clear. These are foundational gaps. You can have the best AI-driven threat detection in the world, but if your admin password is on a shared drive, it's useless.
And the threat they're worried about isn't just some hacker in a hoodie.
No. They highlighted living off the land tactics, where attackers use the legitimate tools on your system so they don't trigger alarms. Groups like Volt Typhoon are masters at this.
Right.
And then you have social engineering. The group Scattered Spider is targeting IT help desks, pretending to be employees who've lost their password and just tricking staff into resetting them.
So the hot take here is pretty clear.
If the fortress banks can't manage basic passwords, the operational resilience regulations are going to get very sharp teeth very soon.
Okay, moving from cyber risks to conduct risks. BBC Panorama had a massive investigation this week into Experian and credit nudging.
This is a really significant story. The investigation featured a woman named Amanda, a mother of 5. She'd worked incredibly hard to clear £10,000 in debt.
And that's when the email started.
The very moment her credit score improved, she was allegedly bombarded by Experian with emails for high-interest credit cards.
She said, the minute you take out one, you get more emails for another one.
It sounds relentless.
It is, and it links to a psychological concept called anchoring. You know how credit card statements display the minimum payment?
Yeah.
That anchors you to the low figure. So even if you can afford to pay £500, seeing minimum payment, £25, makes you pay less, which keeps you in debt longer.
There was also a heartbreaking case involving Santander.
Yes, a customer named Tom with bipolar disorder. During a manic episode, he racked up £7,000 in debt buying musical instruments. He told the bank about his diagnosis.
He told him he was vulnerable.
He did, and shortly after, they increased his credit limit by £2,000.
That is very hard to defend.
It is, and the regulators are cracking down. The FCA upheld a £2 million fine for an advisor in the British Steel pension saga this week. The SFO also charged executives from the Safe Hands funeral plan collapse. So the message is, the consumer duty is not just a box-ticking exercise anymore.
Not at all. It is being weaponized against what you could call predatory helpfulness. If your algorithm nudges a vulnerable person into debt, that's now a compliance failure, not a commercial success.
Let's touch on the economy because the backdrop to all this debt is getting gloomier. The ONS data this week really threw a spanner in the works.
A classic stagflation signal. Inflation unexpectedly rose to 3.4% in December.
That wasn't in the script.
No, analysts expected a fall. It was driven by a nearly 29% surge in airfares and tobacco duty. But here's the trap. Unemployment is steady at a relatively high 5.1%, and payrolls actually fell by about 43,000 in December.
So prices are going up, but jobs are disappearing.
And wage growth has slowed to 4.5%, the lowest in 5 years.
That sounds like a nightmare for the Bank of England.
It's a trap. If they cut interest rates to help the job market, they risk entrenching inflation. But if they hold rates high to kill inflation, they could deepen the employment slump.
Meanwhile, the technology world is not waiting around. A huge move from the New York Stock Exchange this week.
This is fascinating. The NYSE filed to launch a 247 trading platform based on blockchain with stablecoin settlement.
247 trading on the main exchange. That changes everything.
It really does. And it puts massive pressure on London. If New York never sleeps, can the London Stock Exchange remain a 9-to-5 market? You risk losing global liquidity.
And at the same time, the Treasury Slick Committee warned that the UK is exposed to serious harm from AI.
Yes, citing that recent AWS and Lloyd's outage. We are running fast into new tech, but the guardrails are missing.
One last quick hit before we take a break. Gold.
The ultimate safe haven. Poland's national bank has been aggressively buying gold. They've increased their reserves to 550 tons.
Then why does that matter?
Because they have now officially surpassed the gold holdings of the European Central Bank. When a middle power like Poland is hoarding more gold than the ECB, it links right back to that Davos rupture. Central banks are hedging. They don't trust the fiat system.
It's a sign that the whole monetary system is fragmenting. If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. Okay. We promised aliens. This isn't a joke, is it?
It is absolutely not a joke, and frankly, it's one of the most interesting risk management stories I've read in years.
Okay, set the scene for us.
So, Helen McCaw is a former financial stability analyst at the Bank of England, Cambridge-educated, very serious background. She wrote a formal letter to the governor, Andrew Bailey.
And she wants the bank to do what, exactly?
She urged the bank to include extraterrestrial disclosure in its formal stress testing scenarios.
Okay, I have to ask. Does she think little green men are about to land on Threadneedle Street?
No, and that's the clever part. It's not about the aliens themselves. It's about what she calls narrative shock, or ontological shock.
Unpack that for me.
The logic is this. Imagine the White House holds a press conference tomorrow and confirms, with evidence, the existence of non-human intelligence. Not an invasion, just a confirmation. Right.
The argument is this would cause an immediate, total collapse of confidence in all human institutions.
Who cares about your mortgage or your pension if reality itself has just been rewritten?
Precisely. McCaw argues it would cause immediate bank runs, a flight to hard assets cash, gold within hours. The liquidity buffers we have are designed for market stress, like a recession. They're not designed for a total collapse of reality.
So it's the ultimate tail risk.
It's the ultimate tail risk. And her point is, if your liquidity plan is robust enough to survive an alien announcement, it can probably survive anything. It's a challenge to risk managers. Are you being imaginative enough?
I love that. Stress test for aliens, be ready for anything. Okay, let's do a rapid-fire recap for everyone heading into their Monday morning meetings.
First, Prudential. Basel 3.1 and the SDDT regime are locked for January 1st, 2027. Market risk gets until 2028. Check your ICAP cycles now.
Second, geopolitics. Davos signals a rupture. Expect trade wars and tariffs. America First is back on the menu. Third, cyber. CBEST shows foundational failures. Passwords in spreadsheets are a no-go. Fix your basic hygiene before the regulators do it for you.
Fourth, conduct. The consumer duty is hunting down predatory nudges. If your algorithm is targeting vulnerable people, you're on notice.
Fifth, the economy. Stagflation risk is real. 3.4% inflation, 5.1% unemployment. The Bank of England is in a bind.
Sixth, tech. The NYSE is moving it to 247 blockchain trading. The clock speed of finance is about to accelerate.
Seventh, gold. Poland has more than the ECB. Smart money is hedging against the system itself.
And finally, risk. Even alien disclosure is now on the table as a serious thought experiment for stress testing.
You know, if you connect all these dots, we talked about trust collapsing, trust in passwords, trust in credit scores, trust in the rules-based order from Davos. The common theme is that the systems we rely on are far more fragile than we think. So the question I'd leave you with is, are your risk models imaginative enough for 2026? Or are you still just trusting a spreadsheet?
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.